One of the most devastating effects of the double-digit inflation that has plagued the UK economy since last year is the erosion of the purchasing power of consumers. Purchasing power is the amount of goods and services that a unit of money can buy. When inflation is high, the value of money falls and consumers can buy less with their income. According to the Office for National Statistics, ONS, the Consumer Prices Index, CPI, rose by 10.1% in the 12 months to July 2022. This means that the average price level of a basket of goods and services that consumers typically buy increased by more than a tenth in 1 year. For example, if a basket of goods and services cost £100 in July 2021, it would cost £110 and 10 pence in July 2022. This implies that consumers need more money to maintain their standard of living, and buy the same amount of goods and services as before. However, wages have not kept up with inflation. The average weekly earnings for employees in Great Britain increased by only 4.9% in the year to June 2022. This means that the real income of workers, which is their nominal income adjusted for inflation, has fallen significantly. As a result, consumers have less disposable income to spend on goods and services, especially those that are not essential or have close substitutes. This reduces the aggregate demand for goods and services in the economy, which in turn slows down economic growth and output. The ONS reported that the UK economy grew sluggishly during the first 3 months of 2023 as double-digit inflation curbed consumer spending and labor unrest curtailed output in industries ranging from transportation to healthcare and education. Gross domestic product, GDP, the broadest measure of economic activity, increased by only 0.1% in the first quarter compared with the previous 3 months. Consumer spending, which accounts for about 60% of GDP, rose by only 0.2% in the same period. The impact of inflation on consumer spending is also evident in the breakdown of the CPI by different categories of goods and services. The ONS data shows that some of the categories that experienced the highest inflation rates in July 2022 were transport, 15.6%, housing and household services, 13.4%, food and non-alcoholic beverages, 12.5%, and restaurants and hotels, 11.9%. These are categories that tend to have a large share in consumer spending and are relatively elastic, meaning that consumers are more likely to reduce their demand when prices rise. On the other hand, some of the categories that experienced lower inflation rates were clothing and footwear, 5.4%, health, 6.7%, education, 7.1%, and communication, 7.3%. These are categories that tend to have a smaller share in consumer spending and are relatively inelastic, meaning that consumers are less likely to change their demand when prices change. Therefore, it can be seen that double-digit inflation has had a negative impact on consumer spending in the UK economy, especially on services that are more discretionary and sensitive to price changes. This has contributed to the sluggish growth and output performance of the economy in recent quarters. One of the main factors that has put the UK economy in a flatline is the strike action by public sector workers. These workers have been protesting against low pay, job cuts, and changes to their terms and conditions. They have disrupted output in industries such as transportation, education, and healthcare, affecting millions of people across the country. The strike action has been organized by various trade unions, representing civil servants, nurses, ambulance workers, junior doctors, teachers, and rail workers. Some of these unions have rejected the government's pay offers, which they say are below inflation and do not reflect the value of their work. Others have been in dispute with the government and rail companies over safety issues and planned reforms. The strike action has had a significant impact on the UK economy. According to the Office for National Statistics, industrial action contributed to a 0.1% fall in GDP in the first quarter of 2023. The strikes have also caused delays and cancellations in public services, affecting businesses and consumers alike. For example, rail strikes have disrupted travel plans for commuters and tourists, while healthcare strikes have led to canceled operations and appointments. The government has tried to mitigate the disruption of strikes by introducing new laws that will allow employers in critical public sectors to maintain minimum levels of service during strikes. The government has also argued that its pay offers are fair and affordable, given the need to balance the budget and reduce inflation. However, the unions have accused the government of showing contempt for its own workforce and undermining public services. The strike action shows no sign of abating, as more unions are planning to ballot their members for further action in the coming months. The ongoing conflict between the government and the public sector workers poses a serious challenge for the UK economy, which is already struggling with high inflation, supply chain problems, and Brexit uncertainties. How the UK economy has lagged behind other developed economies in terms of growth and recovery from the pandemic. The COVID-19 pandemic has caused unprecedented damage to the global economy, but not all countries have been affected equally. While some have managed to bounce back quickly and return to pre-pandemic levels of output, others have struggled to recover and remain far below their potential. One of the countries that has lagged behind is the United Kingdom. According to the Organization for Economic Cooperation and Development, OECD, a group of 38 rich and emerging nations, the UK's economic output was 8.7% below pre-pandemic levels at the end of 2019, the largest gap among the G7 countries, and substantially below the OECD average of 0.1%. This means that the UK has lost more than 2 years of economic growth due to the pandemic and has not yet regained its lost ground. In contrast, countries like China, India, and Turkey have already surpassed their pre-pandemic output by more than 10%, while the US and Canada have also recovered fully. So why has the UK performed so poorly compared to other developed economies? There are several factors that have contributed to this disappointing outcome, such as the severity and duration of the lockdowns imposed by the UK government to contain the spread of the virus. The UK had one of the longest and strictest lockdowns in Europe, which lasted from March to June 2020, and then again from January to April 2021. These measures had a significant impact on economic activity, especially in sectors like hospitality, tourism, entertainment, and retail. The uncertainty and disruption caused by Brexit, which took effect on January 1, 2021. The UK's departure from the European Union, its largest trading partner, created new barriers and costs for businesses and consumers, affecting trade, investment, and confidence. Although a trade deal was agreed in December 2020, it did not cover many aspects of the economic relationship, such as services, financial regulation, and data protection. The structural weaknesses of the UK economy, such as low productivity, skills gaps, regional inequalities, and underinvestment in infrastructure and innovation. These problems have been exacerbated by the pandemic and have made it harder for the UK to adapt and compete in a changing global environment. The OECD expects the UK economy to grow by 6.7% in 2021 and 5.1% in 2022, which would be faster than most other G7 countries. However, this would still leave the UK below its pre-pandemic level of output by the end of 2022. The OECD also warns that there are significant risks and uncertainties that could derail this recovery, such as new variants of the virus, supply chain disruptions, energy shortages, and inflation pressures. Therefore, It is crucial for the UK government to implement policies that can boost growth and resilience in the long term, such as investing in green infrastructure, digital transformation, skills development, and social protection. The OECD also recommends that the UK should seek to deepen its economic ties with the EU and other partners, as well as cooperate on global challenges such as climate change and health. The UK economy has faced a double whammy of COVID-19 and Brexit, which has left it trailing behind other developed economies in terms of growth and recovery. While there are signs of improvement, there are also many challenges ahead. The UK needs to act fast and smart to catch up with its peers and secure its future prosperity.